Why are people attracted to whole life insurance? Why are people not attracted to whole life insurance? That's a better question, in my opinion, because whole life insurance, most people know what that product is. And if I were to go on Google right now and search what is whole life insurance or just the word whole life insurance, I'll see a dozen articles. A few will have some nice things to say about it, and a lot will have some very, very mean things to say about it. But there's mixed opinions. And what is true is wealthy individuals have used it for a long time. Average individuals have used it for a long time. When I say average, from a financial status standpoint. And banks and corporations use cash value life insurance. You will see corporations sometimes use whole life insurance. Banks do not use whole life insurance. They use a specific type of cash value life insurance referred to as BOLI, bank-owned life insurance, which is a universal life product. It's different. They don't have access to it. But I like to make that distinction because there's definitely misinformation out there. Have you ever heard banks use whole life insurance because they can access the cash value? No, not true one bit. But anyway, to get back on track, how can you use whole life insurance? Or I should say, why would you? Like, why do the wealthy do it? Why do corporations do it? What are the benefits? So let's get on into the benefits. When we look at the benefits of a whole life insurance policy, specifically set up for maximum cash value. So what I want to hit on here is why one would be interested in this. The reason here is for the cash value. The death benefit does carry value to a lot of people. But just in working with individuals, one of the most common things I hear this probably once a week at minimum, is, Steve, I don't really care about the death benefit. I'm interested in the cash value benefit, and that death benefit does become valuable to them long-term because they realize, hey, this is a great means of leaving money income tax-free to my beneficiaries, or I'm going to use it in my estate plan, whatever it might be. It could be for business planning. But typically, it's very common to hear, just through experience, people state, I don't care about the death benefit. How do I maximize that cash value? So we're going to focus on that in this video. So benefits, I like to refer to these as the core benefits to a whole life insurance product that is set up for maximum cash value. Number one, it is safe. It is a safe area to position money. In 2008, people that had whole life insurance policies experienced no loss. Cash values continued to grow. Early 2000 to 2001, when we had the dot-com bubble, and then eventually it burst, people with whole life insurance products continued to see appreciation. It is a safe area to position money that is not tied or invested in the stock market at all. Specifically, whole life insurance. Variable life insurance is. But when we look at whole life insurance products, what happens is the cash value just continues to grow over time. If things are going very, very well or poorly in the stock market and economy, the cash value, here we go, accumulates without risk. The net growth rate in the industry, this is referred to as the IRR, internal rate of return. You're going to see me refer to this a lot throughout the entire video series, mainly because it's compliant language that insurance carriers use. But your net growth rate, think of it that way, with a whole life insurance policy, if it's set up properly from a design perspective, and if it's with one of the major mutual companies, meaning it's set up in a manner where we've seen these products actually work, it'll produce somewhere between 3 to 5% on the net growth rate. And again, that's without risk. It also complements quite nicely the third benefit, which is tax-free, but I'll come back to that. So, grows without any risk, 3 to 5%, and is considered a fixed asset by many. Because I do not have that risk, there's no variable components here, it's not invested in the stock market. Number two, liquid. Cash value can be accessed anytime. If you request a policy loan, from the date you request it, on average, depends on the company, but on average, you will receive those funds direct deposit between 3 to 5 business days. That is the average, can be quicker, sometimes a little bit slower if the company mails a check or something like that, but can be accessed anytime. For full disclosure, if you were to read a full contract of a life insurance policy, you'll notice under the loan request section that life insurance companies can hold loan requests up to 6 months. Now, I've never seen this actually happen. Even if we look at recessions, go back to the Great Depression, I have not seen this actually occur. I wasn't alive back in the Great Depression, but when we look at history, that provision there, really, when I've seen loans held up, and it's never even been a month, but when they have been held up, is typically a case when the paperwork's not in good order, or someone is requesting that a loan be sent to a new bank account that the insurance company does not recognize. They ask for proof from you, the policyholder. Hey, I would like to see your name on this bank account, proof that it's yours. If it's a business-owned account, can you provide proof that you truly own that company? They're making sure that it's actually you requesting the loan, and they are going to ask for documentation in many cases because fraud happens in the life insurance industry, like any industry when we're looking at finance. So they do have compliance departments, legal departments that are very, very good in checking all of this information. So when I've seen loans delayed, meaning you getting your money, typically that's the case, just from experience. Now, common uses, to get back to the fun part, why are people leveraging this liquidity feature? Like, what do people do? We work with people commonly that will access their cash values for real estate, for business. Maybe it's for college planning when they want to pay for their kids' college down the road. Maybe it's for retirement. They plan on taking income and they're going to use the cash value to generate an income stream once they retire. And they've got the tax-free benefit there too. But it can be a lot. What we commonly see is real estate and then using it almost as a business line of credit. That is extremely common. I probably talk about this because that's one of my favorite things. I thoroughly enjoy business, have a lot of fun with it. And if you can build up a lot of cash just in your bank account, then you can take advantage of opportunities for your business to continue to grow. So what a lot of business owners will do is the exact same thing. And they'll view it, hey, instead of having it in my bank account, which doesn't do anything, I can put it in this policy that actually grows for me, continues to compound. We're going to hit on that piece where you can access your money, keeps on compounding. I've got a tax benefit. Oh, and I've got life insurance as well, which is fantastic. And that same mindset is applied among real estate investors. Some other stuff here. Cash value, I just hit on this, continues to compound when accessed. So a unique feature to a cash value life insurance policy is once a dollar passes through the cash value life insurance policy, regardless if I just let that dollar sit and grow, or if I elect to take a loan against it, I continue to receive dividends and interest, call it earnings, on my entire cash value. Any money still in cash value, think of it as equity, and any money I have loaned against the policy. So if you've got 100 grand in cash value, you borrow at 50, dividends are still applied to the full 100. Just like a piece of real estate that you might own, if it's worth $100,000, you take a $50,000 loan against it. If the fair market value appreciates by 5%, is that 5% depreciation on the full $100,000 home value or only the remaining equity? Yes, the full home value. So life insurance works in the same manner in that respect. And we'll touch on exactly how that works, how it benefits you, how it benefits the insurance company once we get to the loan section, or you can skip ahead and look at that as well. So liquidity, nice feature. People will take advantage of it. In summary, I've heard this from wealthy individuals state it's kind of like a high yield savings account that's got a nice tax benefit that I can access like a personal line of credit. Like it's a great, safe place to put some money. Some people have mentioned that, and some use it more frequently than that, or to a greater degree. Third piece. So this really is what makes the first 2 points very, very attractive. And we've got here copying the wealthy. So whether you are in a very high tax bracket or not, this is what is attractive to people who are in a high tax bracket. So how can we copy them or just understand why are they doing it? What's that extra appeal? Here it is, tax-free. So the cash value on a whole life insurance policy technically grows tax deferred if we look at the true taxation of it. However, we can access the money completely tax-free if we do so properly. Now, if you do so properly, how would you like to buy a product? I take a policy out from me and I say, yeah, it's tax-free if you do it right and leave it at that. It's like, all right, you're going to give me the rest of the information? Like, what's going on here? The reason I do that is because life insurance for a long time has been marketed as tax-free. throw the word tax-free in there. That gets people's attention. I'm interested. Tell me more about it. But where people have gotten into trouble with life insurance policies, meaning they've had to pay taxes unexpectedly and potential lawsuits pop up, and we don't want that, is when I tell you it's tax-free and leave it at that. The thing is, it is possible to run into taxable events with whole life insurance policies where I have to pay income tax now, and it can get even uglier than that with penalty taxes and such. It's very easy to prevent, but we do want full transparency on that before starting a policy or making sure our agent is always taking care of it for us. We do work with a lot of people that say, hey, Steve, you're boring me with all the details. Just set it up for maximum cash value and make sure that everything is done right. Can you do that? Yes, we can do that. We've got a full staff here that specializes in just that. And I work with them on a regular basis every day. So here we go, just in writing. The cash value grows tax deferred, but it can be accessed tax-free. And it is possible to have a situation in which taxes must be paid. Our whole life taxes video provides full detail on that. Some examples: if I trigger what is referred to as a modified endowment contract, if I cash a policy out with a gain, if a policy lapses due to a large loan balance and there's a gain, maybe a lot of unpaid loan interest has accrued, that can actually increase my tax liability there in the event of a policy lapse. Little things, they're not little things, big things like this are very, very, very important to be aware of. You ever buy a product, you thought it was the best product, maybe it's a service ever, and then you find out after the fact, you read some reviews on Google, like, oh, that's not that great. How come so-and-so never told me that? Or put it in a disclaimer somewhere. Granted, it's a lot of information, maybe they couldn't, but you've got to have that somewhere there just so I have the awareness. Whether I'm looking at everything, my advisor is. What I have seen in working with wealthy individuals is they typically have advisors or someone that is doing a lot of the vetting for them, reading through documentation, interviewing the agent or broker that they're working with to make sure that they're setting that product up truly in the client's best interest, not their best interest from a commission standpoint. It's important just to be aware of all of this stuff. So, interesting material here to accelerate toward the end of this video. So, when we look at funding a policy, so if you said, okay, I'm interested in a policy again, why are the wealthy doing this? What are the benefits here? Why are they attracted to the product? How's it work? Funding the policy. When it comes to premium and PUA payments, those are always made with after-tax dollars, meaning I cannot deduct them like I could with a 401k. That'd be nice, but it functions more like a Roth account, where I fund it with after-tax dollars, and then it grows tax-free. A Roth does that. With life insurance, I fund it with after-tax dollars, it grows tax-deferred, and I can access it tax-free if I do so properly. The cash value growth, tax-deferred. Access, tax-free. Death benefit, paid out income tax-free. Very important to mention that word income. Life insurance, death benefit proceeds are not automatically paid out tax-free, period. For example, if someone has a high net worth and they exceed the estate tax limits, that life insurance death benefit can be included in their taxable estate. This is where it's very common to see someone set up their overall estate plan with a trust or multiple trusts in order to leave more money to the next generation completely tax-free or minimize the taxable impact. And that is something that we do not do here at our company. We do not write trusts. We do work with one law firm we refer individuals to that is very, very good. That is Elizabeth Morgan's firm. She is the best I know for a variety of reasons from a business standpoint, and you'll tell this in 2 seconds from talking to her. She's a considerate person and looks out for people. All of her associates do too, from my experience with them. But just full disclosure there, we're not tax attorneys or CPAs, though we do work with some only good ones because I'm very, very picky as far as who we partner with. They've got to know what they're doing, and they also have to care about their clients, just to summarize that. So if we look at a whole life insurance policy over here, let's assume you're paying money into it. How does it work? So the funding, this is money you are actually going to pay into the policy. You can add premiums and PUAs to the policy, and you can fund a policy for a short period of time, Let's assume that this is 4 or 5 years. We're going to see examples like that throughout this video series. Or you want to fund it forever. And your funding can fluctuate. We can add more, add less. You can make it very flexible. But here's the funding in blue, money you pay into the policy. Then we've got the death benefit. With a whole life insurance policy, what you'll see over time is that death benefit gradually increases. There are cases where it may decline a bit if we're utilizing term insurance riders and such. We'll explain exactly how that works when we get to the policy design section. But generally speaking, what you will see, while it might dip at some points in time, over the life of the policy, it will gradually increase. Maybe it starts out level for a time and then it goes up. But what will happen as time passes is the death benefit will go up if we do everything right and don't have a loan outstanding that just abuses the policy or something else. But we'll hit on all that. And then we've got the piece that everyone's interested in, the cash value that goes nowhere but up over time as well. With a whole life insurance policy, you will always see the guaranteed cash value interest rate exceed the insurance expenses. So even if you were to look at the worst case scenario, the minimum guarantees, what you will see is that cash value continues to appreciate. That's a difference with a whole life insurance product compared to other cash value life insurance products. The most popular that we see is indexed universal life insurance. That does offer great earning potential with respect to the cash value. But when we look at the drawbacks, is what happens is the insurance expenses always exceed the guaranteed rate on a product. I have lower guarantees, and I do have more risk with that product. Not to say it's a bad product. We won't get into that right now. But focusing on whole life insurance, that's what our company specializes in. That's what happens. Gradually increases, and the guarantees will always exceed the insurance expenses. Now, some cool stuff, right? When we look at the benefits, safe, liquid, tax-free, my core benefits, I can access that money while it continues to compound. What are the drawbacks? Because what we don't want to do is just tell you all of the beautiful features about whole life insurance, and then you start finding out on your own, or someone else brings it to your attention. Hey, did you look at this? Here's what a lot of people don't like. So what are some concerns people have had, or what are the main drawbacks that are important to be aware of? Number one, cash value, negative in the early years. You'll always see this with whole life insurance products. Worst year is the first year. In the first year, no matter how well that policy is designed, I will have less money in cash value than what I've paid into the product. I pay $1 in. If I have a bad policy that's just a basic old school whole life insurance policy, I'll usually have 0 in cash value in the first year. Now, if I have a well-designed policy, I'll have somewhere between 80 and 90% in cash value in the first year, depending on the company and product. But a drawback, even at 80 or 90%, say it's 90%, it's a 10% loss in the first year if I'm laser focused on the cash value. Here's a big one. A lot of real estate investors have expressed this. The loan interest rate can exceed the growth rate. Have you ever heard you can put your money into a whole life insurance policy and you've got a dividend rate of 6% and you can take a loan against it at 5%? What goes through your mind when you hear me say that? Dividend rate of 6%. You can put your money into this whole life insurance product. Take Mass Mutual. They're paying a 6% dividend in 2022, and you can borrow against it at 5%. What do you think? What do most people think? That's a positive 1% spread. Sign me up, man, all day long. Now, imagine if we sold you a policy based on that statement, and then you found out as you actually look at the cash value growth that it's not earning 6%. In fact, in the first year, you're negative, the first several years before I break even, but the average growth rate or internal rate of return, just for the sake of simplicity, is 4%. And you're still borrowing at 5%. How would you feel, especially if you found this out after you've dedicated money toward the policy? This is where people become upset. So, looking at the loan interest rate and seeing, is it a wash? Does it exceed the growth rate? Am I earning more in my cash value than what I'm paying in loan interest? Doesn't matter what those numbers look like. I just want to see it up front and then decide if I still want to take out a policy or decide, hey, maybe I'll put money into a policy and leverage loans elsewhere. Some years I will use my policy. Just being able to pull the levers that give me the best overall results. When I say give me the best overall results, I'm pretending I'm you, the policyholder here. And then here, if poorly designed, the policy that is, the benefits do not show up for over 10 years, sometimes more than that. Let's wrap up with this actually, because when we look at cash value life insurance products, here's a basic whole life insurance policy. Have you ever been sold a whole life insurance policy or pitched on one? Remember when I first started in the business, particularly on the whole life side, my first 9 months, I started a company where we sold final expense insurance and Medicare supplement insurance, and I didn't do that well at all. But when I first got into the business, a lot of times these kinds of products were sold, which is just a traditional old school whole life insurance policy. This is a 35-year-old individual. The age is somewhat irrelevant in this case, but $10,000 going in per year, and this is pure premium. This is a basic whole life insurance policy, which is what most of the general public own who take out whole life insurance policies. Whether this is $10K, $2K, $250 a month, whatever it might be, it's usually 100% base premium. No riders, nothing fancy. What do you notice about the first year? If this is you, you've just paid in 10 grand. This column is your money column, total cash value end year, 0. The second year, you pay another $10,000, and it's not quite a 0, but you've got $900. That means you've dished out $20,000, and you have less than $1,000 in cash value. If you die, a death benefit's paid out, right? So you can cash in that respect, but we don't want to die. So it takes a long time. Beginning the third year, I finally start to see some money come back. But look at this. By year 10, you've paid in 100 grand and you've got $78,000. And this is based on the current dividend rate. If you look at the guarantees, it gets even worse, where this is a 0 in year 2. But as we continue on, I mentioned 10 years as far as getting our money back. It takes a little bit longer. It's closer to 15 here, between 14 and 15. For year 14, you've paid in 140, you've got 137. Year 15, you're at about 155. Would you do this? A lot of people wouldn't. Not when they find out as far as what could have been from a design standpoint. And going back to the title of the series, How to Copy the Wealthy, this is not what they do at all. So when we actually look at what the wealthy do, here's a quick example. This was an actual policy. One of the options shown, he actually went with an option slightly different than this, but a whole life insurance product, large dollar amount going in, right? $1.1 million per year. You see a 0 there. Now, we're over 90%. Got about a negative 8% hit right out of the gates, breaking even between years 3 and 4. That's what's highlighted in yellow. I'm sorry, that's actually between years 4 and 5. So we've got 1.1 million going in per year. My point is, completely different story, maximum cash value. Now, if you're looking at this and thinking, okay, I can't put in $1.1 million per year to a whole life insurance policy, Steve. Can I get these types of results without that type of dollar amount going in? And the answer is yes. And that's what we're going to look at throughout this series. So here's a 31-year-old individual funding a policy at $10,000 per year. We see he's got about 85% right out of the gates. This is a different product, but we see cash rich, breaking even year 5. IRRs, we'll go through that. That's his actual growth rate over time. And then we've got a similar design for his wife. A lot of material here. In short, we see 10,000 in. Look at this, 9,000 in cash value in the first year. And that hit is almost identical to what we saw in that wealthy individual, paying in 1.1 million. So whether you're paying in 10,000, maybe it's 5,000 per year, $1 million per year, we can design it to be extremely flexible. And we'll go through that as we look at actual examples, build the policy live, show you how to make it very flexible. Maybe you like the idea of paying up to 10,000 or $1 million per year, but you don't want to get billed for that. So how do I commit to a minimal amount and add more discretion? In any event, I hope you enjoyed part 1 of this video series. We will continue on and we'll see you in the next video. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.